Guys, thanks so much for being part of the last panel of the day. I get the privilege to now switch to being a moderator. With me is my team, and I'd like to introduce them briefly. A bit of background, we believe in multidisciplinary design. So we pull from people with a lot of experience in law, in economics, and all sorts of different disciplines. Byron, I'll let them introduce themselves briefly after I go through each one. Byron is our head of engineering at Sonata. His background is in design, and he's bludgeoned it into me over the years that graphic design and design have nothing to do with each other. Design is a very hard and real science. To the right, we have Dr. Alexander Hobbs. He's one of our two resident astrophysicists. Miles is our other one. So they bring with them very, very different vantage points and viewpoints into crypto. I myself come from biochemistry. So you're really going to hear very different thoughts coming from different places, but around a central theme. And it's a great way to kind of end off the innovation track that you've listened to today, to look at what are the current trends, the current things that are happening in blockchain, and where could the future go, and how do we get there. So very, very briefly, if everyone can introduce themselves in sort of 30 seconds, Miles.
Yeah, so my background is in computational astrophysics. So especially with this code-to-earn stuff, I'm coming from the side of kind of the person who's been coding for 20 years. So that's kind of my background that you'll hear in this. And when he said we had different perspectives, I'm a planets guy, Alex is galaxies. So that might come out too.
Worlds apart. Byron.
Yeah, so as Andrew mentioned, I come from a design background, but moved very swiftly into development in order to implement those designs, and have gone from everything from machine learning in an education setting to obviously fintech, and then fintech naturally into blockchain, which has led me here.
Yeah, hi. So I'm Alexander Hobbs. I'm Director of Science at Sonata, and as has been mentioned, I also have an astrophysics background. Galaxies obviously being better than planets just because they're bigger. But I moved into the blockchain space about 2.5 years ago. And it wasn't actually as big of a change as I had suspected. It turns out that modeling blockchain networks has a lot of similarities with modeling galaxies. They're both complex systems, but obviously the use cases are somewhat different.
So with that in mind, I thought it would be good to maybe just spend a little bit of time starting as macro as we can. So pretending some of you in the audience don't have a deep understanding of blockchain, but maybe just more at an enthusiast or interest level, and just kind of to ground what we're all talking about, and then we'll sort of go lower very quickly. A lot of people still that I talk to today believe that blockchain technology is a scam or a Ponzi scheme, or isn't that how drug dealers pay each other? That's still a prevailing sentiment in a lot of the population. So I'd like to look at sort of just a macro view on the financials and also the tech. The term that's kind of emerged is distributed ledger technologies, which is a terrible, terrible term because it's got nothing to do with distributing ledgers, right? But it's the name that's stuck. And I can just sort of walk you through that and just to highlight why the technology is fit for purpose, right? So in a room here, let's say we want to keep a ledger of accounts, and each one of you people represents a ledger, right? And everyone on this half of the room holds a record, Alice paid Bob 1 Bitcoin, right? And just these 3 people over here, they've got a different state of accounts. On their ledger, it says Alice paid Charlie. Who's right? That's the problem, right? Because do I trust the majority? Because the majority aren't always right. If it was down to whoever distributes the account of ledgers most is the correct ledger, which is what the name DLT implies, then you have a simple Sybil attack. And a Sybil attack is me being a not-so-bright hacker. I make 100 million copies of the blockchain that says, I paid Bob. And those 100 million copies throw the consensus so that the people who hold the true accounts that Alice paid Charlie get their voice not heard. So it's not a distributed ledger technology. That's not how we decide on who gets paid and who doesn't. It uses something called the longest chain rule. It comes down to which ledger has put the most work into it. If these guys have 4,000 blocks and these guys have 2 blocks, you're all faking and they're the real deal. And the reason is it takes time and work to build a ledger. That's what we call proof of work. Time is something you can't copy. Data is something you can. So the people that have the most time are the correct people. This is a fundamental solution to trustlessness and keeping a record of accounts secure and fixing a distributed clock. Before 2009, we did not have distributed, well, before 2009, we definitely had distributed ledger technology, but we did not have blockchain. It's a real tech, and it really is here to change the way that we deal with common accounts and thinking about value. And then finally, just a sort of a financial remark. We've gone from a market assets under management 3 years ago of $262 billion to today, and that was to the day 3 years ago, to today we're sitting at $1.3 trillion assets under management. That means in 3 years, the ecosystem has done a 5x. Okay? And that's, if that doesn't impress you, then very little will. And the reason I say that is, talk is cheap, but you know something is real when people start putting real money behind it. And the forecasts are that this industry will really grow to between $40 and $100 trillion in the next 15 years. Blockchain is going to take on the stock market and win. So we should take this all very deadly seriously with the understanding that this is real tech and the understanding that it represents real money. The questions that we really want to ask now, and the purpose of today's panel, is what are the current trends? What opportunities have been missed by the incumbents? And can we really sustain more growth, or are we kind of entering into a bear market where 1.3 trillion is realistically where it's going to get to? So these are the sorts of things that we want to unpack, and these are the questions that we've get around it. And the answers that we're going to build really highlight that creating value is what's going to take us from where we are to the stock market. So Alex, if I could start with you, what is a good definition for DeFi? What is DeFi?
Okay, so DeFi, as I'm sure everyone is aware, is essentially the term for moving what is traditional finance, or TradFi, which is a term that I heard recently, into the blockchain space, into the decentralized space. So it's a simple concept, really. It's all of the things that you could potentially do with finance, all of the instruments, all of the financial products, collateralization, loans, all of that kind of thing, but you're doing it in a way that has decentralized ownership rather than ownership that goes through a centralized financial institution.
Fantastic.
And TradFi there is traditional finance as opposed to TradeFi, or?
Yeah, TradFi without the...
Yeah, this is the great semantics of the new FIs, the DeFi and GameFi and so on.
Yes, if you want to make something cool, just add Fi. Even sci-fi works. So Miles, what is the difference between DeFi and other instruments in the crypto space, like a traditional ICO? I mean, ICOs seem to be how you raise funds for stuff. DeFi seems to be how you raise funds for stuff. Where is the difference?
Yeah, well, I would go along with kind of Alex's definition there, that I think DeFi kind of covers all the traditional finance, but decentralized. And it doesn't really overlap necessarily with ICOs, with the exception of how you raise funds as a new company. So for example, the ICO is something where you can go and you can offer your coin and you're essentially getting equity, for example. But an ICO, in principle, could also be giving you a coin that has some utility that you expect to also gain some revenue from. At the same time, when you go to DeFi, when you invest in this, you expect that this is something with an actual use, for example, staking or liquidity mining or something, that also gets you some kind of actual real source of revenue. So they're not really comparable, but they're more of like a Venn diagram where there's some overlap between them, I would say.
Fantastic. Byron, if we look at so DeFi hasn't just been tried, distributed finance or crowdsourced finance isn't just the behest of blockchain and crypto. There are other projects like Indiegogo and Kickstarter. And how does something like that, crowdsourced funding, compare with DeFi?
Yeah, so there with something like Kickstarter or Indiegogo, you're talking about a centralized body, actually. So they're not really DeFi in the sense that we mean DeFi here. You're talking about a specific gatekeeper who can pick and choose who gets to be put in front of users and in front of funders, and funders just kind of have to take it. They kind of get what they get. And Kickstarter or Indiegogo themselves, if they're, say, a US domiciled company, they're subject to US regulations. And of course, at the end of the day, all of this stuff is actually manually triggered on something like a Kickstarter or an Indiegogo, whereas in a DeFi platform, you're looking at an algorithmically defined means of funding projects, regardless of where the person requesting the funding happens to come from, what country they're in, what the purpose is. It all gets settled and handled in a completely decentralized way, which you don't get in something like a Kickstarter or an Indiegogo.
So Miles, just help us look at the last 5 years. How have we seen the ICO markets evolve, and how does that compare to the DeFi markets? And what I'd like to do, I'd like to consider just Ethereum, so we can compare apples with apples. So Ethereum support DeFi projects. They also support ICO projects. What have the trends been in the ICO fundraisers versus DeFi, and how have they evolved?
Yeah, I'm not sure I can do it specifically with Ethereum, but ICOs peaked around 2018, I want to say, with about 6 billion per quarter. This was like on the back of some large projects. But since then, ICOs, the funding raised, not the number of ICOs, but the funding raised from those has dropped off by about a factor of 10, mostly due to regulation and the uncertainty in that area. Whereas DeFi has seen a pretty steady uptick, and I think now the market capital is about 55 billion. Thereabout. So that's really on the up, and the ICOs are kind of really struggling to overcome the uncertainty around the regulation. No one's really sure if ICOs are a safe bet anymore. And there's a few prominent cases we've seen in the past here, in the recent past. So I think people are moving to DeFi, and I'm not necessarily sure if they're doing this because the regulatory structure is better, but because it's not feeling kind of the SEC breathing down on the neck like the ICOs are. So it's really right now I think people are kind of chasing kind of the Wild West without the regulation. That would be my feeling about this.
And the reason I'm going to field the next question to Byron is that he did spend some time in banking as well, and has a very good understanding of finance and economics. If you were going to invest in a DeFi project, Byron, wearing an investor hat, how would you go about evaluating the value of these projects versus your return? What are the sort of things that you look for in a good DeFi project?
I actually think that the answer to this question is not just for DeFi, it's for pretty much any asset class right now. And it comes down to one word, which is utility, right? If a particular investment doesn't have that intrinsic utility, especially in a world now that we're entering that is more inflationary, where we're entering kind of a bear market, kind of a sideways market, not just in crypto, but in a number of asset classes, stocks particularly. We have to start at utility as the first step. And then from there, we can start looking at the more, I would say, traditional fundamental factors, which would be things like looking at the team, looking at the vision, looking at where these things are going. And also putting that in context with where, in the specific use case of DeFi, where it is within the context of where DeFi is today. So is this a project that is maybe 5 years too late? Is this a project that's 5 years too early? Are there factors that make this not a good fit for the context now? Or is this something that can develop into something great in the future? And as you say, there's a huge multiplier present here in this market, which you don't get in something like the stock market. And so the opportunity for, let's say, reward versus the risk is far, far greater in something like DeFi or crypto in general.
Yeah, just to jump on from my last kind of point there as well, I think when I'm looking now projects, I look at also, are they aware of the regulatory future in some sense? Because there's a lot of great projects, for example, like EOS is one of these that then got hit by the SEC. And there is a lot of kind of, you can't really not take account of this anymore. You need to think about this. And if you're not thinking about that, then I'm much more bearish on your project than I would be if you said, yeah, we thought about this and we have a plan for this.
And so here, and this is going to kind of end our first session, just trying to understand, what are the different funding mechanisms, what is crypto. You said something interesting in your last comment that I'm going to build on, and that is you say looking at the fundamentals. There's two kind of strategies, obviously, to investments. You can do fundamentals, or you can have a kind of a day trader hat on, right? Does it make sense in DeFi and blockchain to even think about fundamentals? I mean, does those fundamentals exist? Is this a misnomer? Where do we get fundamentals from? Does Bitcoin have fundamentals? So I'm going to open that up for the whole floor.
Yeah. Okay. That is a great point, and this is something which is the standard attack, as far as I can see, on anything blockchain, anything cryptocurrency, which is that there is no fundamental utility behind it, or there is no fundamental aspect to it beyond speculation. So obviously the market is intensely speculative. I think no one disagrees with that. But I see blockchains and cryptocurrencies as experiments with a form of decentralized ownership. So Bitcoin was the first, and it designed a form of ownership around money that doesn't require trust in a central body. And since then, Ethereum and all the others building NFT platforms and all that kind of stuff, we're looking at an experiment that is trying to decentralize the ownership of digital assets. And this is one of the first times I think that the general public has had the chance to see an experiment unfolding before it's in the stage where it should really go out to the public. And it's certainly the chance where they've been able to see that experiment unfolding and invest in it. And I think this is one of the things which is messing with people's heads to a certain extent. There's a lot of anger in the sense that I should have been protected from this. And I think it's because people are viewing it as, oh, if someone wants me to invest in it, it must be in a state where it already has utility, rather than the promise of future utility if we manage to solve that decentralized ownership of digital assets problem.
So I want to kind of build on that, but start to segue a little bit. When I first heard the term NFT, having been in the space for a number of years, I really just sort of wanted to roll my eyes. I'm like, what are they going to come up with next? Let's just create another 3-letter acronym, pretend it's going to make everyone filthy rich, dump it on the market, and keep the cycle going indefinitely. And over time, I had to sort of sit down and try and sort of understand why the hype wasn't dying away, because normally these things come and go pretty quickly, but NFTs seem to weirdly have kind of sticking power, and people, reputations and brands were sort of getting on board, and this sort of confused me, especially from the banking sector is still trying to be like, oh, should we accept crypto? But everyone's jumping over NFTs. Maybe we should just get the first issue out of the way. And then I realized what was actually going on. It was a intuition that people weren't formalizing. NFTs could be the first time that we're moving away from a price-backed asset to a value-backed asset. And I'm not talking about buying a picture of a Bored Ape for $69 million. I'm saying that everyone wants content. We enjoy playing games. We enjoy listening to music. This is something that has value. And when you create an NFT, you're adding value. It's not just about speculating on price. And so that's a great promise. But the technology really isn't delivering on that promise. But the move from price back to value back is a very encouraging and optimistic movement. So that's kind of when we at Sonata start getting very, very excited, because we're all about value and trading value. And so NFTs started to kind of shine a light on the message that we were trying to deliver and give us a forum to really sort of unpack all of this. So trying to understand where NFTs are sort of used mostly, I'd like to chat a little bit about GameFi. It's strange to look across the generational divide. In-game item trade generates as revenue globally per annum, conservatively $80 billion, optimistically $200 billion a year in revenue. That greatly exceeds what Hollywood does globally, right? So it seems to be that like the younger generation is very comfortable with thinking about games as economically valuable, and the older generation is like, this is just all make-believe, this is pretend.
Well, I was actually surprised by this too, because there's a statistic that says about 25% of mobile gamers will buy like a microtransaction, some in-game item, like on a daily basis. And for console gamers, it's closer to 50%. which is just somehow nuts when you think about this. But this means if you have 3 billion gamers, you have a lot of people that are buying these items. And so it's not small. I mean, it's really a huge market.
This is in the freemium kind of, in theory, free-to-play models that turn out to not be free-to-play because most people realize that in order to win or in order to get ahead in the game, they're going to have to spend the money.
This is essentially your
model. Yeah? Pay to win, essentially.
Play to win, or they call it freemium or free-to-play.
Spend to win. Pay to win,
Yeah.
So Byron, maybe from your perspective, why is gaming such a big deal? Like, what is it about playing a game that is so addictive? Like, you know.
I'm going to try not to go too into deep a rabbit hole there, but essentially, in my view, and this is very much opinion, games are kind of the pinnacle of entertainment for users, because if you look at something like music or a book or a movie, these are all, to some degree, a passive medium of consumption. Gaming takes audio, takes the visual, takes all these components of an experience, let's say, and it combines these with an active component. You literally have an effect on the outcome of what you're taking part in and what you're consuming. And I think that's something that's very unique to gaming. To add to the point that Miles made now, I think I'm either possibly the first generation or one of the first generations where it didn't matter whether you were a sports guy or an artist or you were a chess club geek or whatever, you all played games. And my generation has kept playing games up until now. I mean, I play games as a hobby. And the same is true for every single generation under me, right? Now, I'm only about 30 years old, so let's say there's 3 generations under me, and there are maybe 3 generations or so above me. So only 3 generations or 4 generations currently play games. But one day I will be an old man, and there will be 6 generations or 7 generations under me, and they will all be playing games, just like they do now. And if the market is valued at, let's say, a 200 billion or a 300 billion, or whatever the number is now, how big will it get to when 7 billion people on the earth are playing games? You know, so that's an incredibly impactful medium for something that's only been around since Pong in the late 70s or early 80s.
So that's I think the promise of where everything's going. And one of the problems that you have is there isn't just one stakeholder in this vertical that needs to get on board to make the whole thing work. You got to get game studios, you got to get traditional finance, you got to get crypto enthusiasts, you got to get game players guilds all together. And so one of the projects that we run is playingfields.com, where we're trying to build a collaborative community to bring together all of these people around gaming as a valuable asset and a valuable ecosystem. And I think really this is kind of the tip of the iceberg. And the NFT experiment really highlighted one great failure, and that is we don't think enough about data rights versus data management. So data management is my ability to copy, create, edit, delete, and data rights is my ability to buy, sell, hold, revoke, right? So currently, if you try to deploy an NFT offering, you want to commoditize it, you want to generate some revenue, what you're going to do is you're going to put your data management onto something like IPFS or storage or whatever it might be, and that's where you do the storage part of it. And then you're going to use Ethereum to handle the rights part of it. But now you're not using one common ledger that we can all agree on that's backed by proof of work, so, longest chain rule. You're really trying to run multiple environments, and you're going back to having to get people to trust you, where you say, trust me, what's stored on IPFS really is this thing I'm promising on Ethereum, but who's doing that auditing? Who's doing those checks, right? So what we're seeing is we're seeing rug pulls and all sorts of things going on. Axie Infinity have not fallen on the good side of these sorts of problems. So Byron, my question for you, what we're trying to do at Zonata is to realize that we need to handle the value push independently from the payment push. As was alluded to in our previous panel discussions, you don't need a double entry where Alice pays Bob. You need a dual double entry. Alice pays Bob, and Bob gets some game item or some song or something of value. And if you can get that atomically on a blockchain, the distribution for payments and the distribution of the assets are fully distributed throughout the market. And we don't have to invent a whole lot for us to really start showing a shift in what's possible. Imagine I could offer you in a layer 1 blockchain a receipt for something that you buy. So I can mint and generate a little magical receipt that's stored on the blockchain. And when you pay for your coffee, I give you the receipt. That mechanic seems not super magical. What could you do with this kind of receipt technology? How would it enable the ecosystem? What's the big deal for being able to do this at a layer 1? And should you be able to do it at a layer 1?
Yeah, I think it is actually quite a big deal because you're essentially showing some value has exchanged hands in exchange for the tokens, right? So this is important. I mean, we do this every day when we walk into a store and we buy a coffee and we get a receipt for that purchase. And this is used all over the world every day with a lot of use case. And it's something that we don't really have atomically right now on blockchain, which is the big problem, right? So if I take Bitcoin as the very hardcore example, if I send you 5 Bitcoin, there's no entry on the ledger that shows that I sent you those 5 Bitcoin in exchange for something else. It's kind of charity, right? And so what you want is, if you can show the exchange of one asset for another, you've got a very, very simple, atomic, and native execution of a trade, which you can audit. So just for the receipt, in terms of things like fraud, AML, all of these sorts of things, a lot of this stuff can be real-time audited as a trade, as you said, on a double entry kind of ledger, dual double entry kind of ledger. And that's very powerful. But I think where what you're alluding to is kind of like what can we do with receipts beyond that, right? Which is the idea that if a receipt can possess some kind of identifier, it doesn't matter what it is. It could be a word like share, property share, for example. Then I could create a set number of these property shares as receipts, let's say 1,000 on the chain, and I could then crowd fund the purchase of a property by selling these shares at X amount in a completely decentralized way, speaking to the DeFi. And I could do this without a smart contract. I could just do it through a few lines of code to get things working. And I would essentially have the same thing as what I currently would get through something a bit more complicated, like a smart contract. And obviously, if I can do property crowdsourcing, I can do in-game currencies. I can do any number of things pretty much that you can think of that would consist of a fungible asset store that I've created for some purpose.
I'm tempted to just unpack that in-game currency thing, which I'll just run through at pace. If you want to invest in a new game and you buy some of their future coin as an ERC20, that ERC20 is not your game currency. That's the thing that you're going to use in the future to redeem your game currency once it's available. And the SEC has a problem with that because that's kind of classing it as definitely something that you're going to get in the future and not something redeemable right now, right? And so if you can have a receipt where you say, this receipt is, it's not a contract. It's not something that will be redeemable in the future. This is the thing the game is going to use to issue you an item. I can do that trade in a contractless way right now. And that brings us to our sort of closing comment. Now that we've kind of looked at the evolution of everything, now we can start looking with a dual double entry mechanic, understanding what DeFi is, understanding the ecosystem and putting it all together. We can start to do really bizarre things like code to earn. So I think we're going to sort of end just discussing that as a use case. And then after the discussion, because we're running out of time, unfortunately, we can pick up any other questions from the audience. Now, the problem inherently with 70% of enterprise bugs that you find in normal software that gets deployed, it comes from open source libraries. And the reason why open source libraries introduce bugs is the guy who wrote it did it as an act of charity, right? So he was a highly knowledgeable accountant who also happened to code in Rust. He wrote a beautiful library for handling something, and then he just said, meh, gave it to the community and stepped back, right? And that piece of code gets used persistently for decades to come, right? And if you're not talking about a way to give that coder a revenue stream, you're not giving him the tools to maintain that code base. I mean, despite his willingness to give away something for free to the community. At least if he was getting some revenue stream, he could employ some other coders to handle the maintenance and bug repair. So if you want open source to work, you've got to give people the option, if they want it, to somehow receive a monetization stream for participating in that, at least in future, right? And so what do you think the impact of... So code to earn is the ability where coders have access to a marketplace, because code is inherently more fungible than other assets are, right? As long as, if I need to add big numbers together, if I use this library or that library or that library, I don't really care as long as it gets the job done. But if you have the ability to put those code repos up for sale at different price points, this big number integer adder is, carries zero risk and can be used for finance. This one is good for game deployment. This one is good for whatever. And so if you bring in this degree of fungibility, and I predict that one of the weird things that we're going to see emerge is, we have compute as a service. Enterprise love this. They don't want to have the brick and mortar cost of paying for storage. They can outsource that to Amazon or Google Cloud or whatever it is, and they can pay for it as it scales to their pocket. One of the big things that I predict will start to emerge in the next year or two is not compute as a service, but compile as a service, which is you as enterprise can choose based on license agreements, bugs, risk, support, service levels, which libraries you're going to cobble together to create what offering, right? So at the end of the day, that gives me as the consumer choice, and when the enterprise compile that target down to a useful application layer, developers get paid in real time in much the same way that blockchain enables musicians to get paid in real time. So just opening up that code to earn discussion, what are your feelings on how enterprise would view adoption of that kind of model, and why? What are the benefits, Byron?
Well, for enterprise, I mean, one of the ones you mentioned there was licensing. I know of a case in particular, and I can't mention it publicly, of a company that unfortunately accidentally violated a particular license agreement within their software, and they had to halt what they were doing in terms of business, which can result in millions of lost revenue if the licensing isn't done correctly. The problem is that licensing for code, even open source code currently, is still done in a very manual way. And if you can automate the licensing, in other words, the licensing needs to be able to move with the code and execute automatically along with the code, then you have sort of like a real-time automatic auditing system. And enterprise can adopt code that conforms to these licensing standards. So if enterprise wants to feel safe in the code that they're using, they can make use of the code that happens to use this automatic licensing so that they don't have to use extra manpower to make sure that they're doing the right thing. I think that's a huge benefit for enterprise.
And passing the last question on to Alex, just in closing. Alex, are you still going to work for Zonata if you can earn by coding? That's a joke. My final question to you, Alex, is how do you see users and code producers reacting to such offerings?
Yeah, this is an interesting one, particularly with the coders. My naive kind of experience with coding, which is also like Miles coming from the academic modeling of astrophysical phenomenon kind of coding, so it's not a software development direction. It was that coders, just like artists and musicians, have a starving coder paradigm, just like a starving artist or a starving musician paradigm. Now,
that's just because we were academics.
Sorry, starving academic, yeah. Now, I'm actually sort of reliably informed that that isn't actually necessarily the case. It's not quite the same model that coders would have with this kind of paradigm as artists would do, digital artists would do, or musicians would do. But fundamentally, it still comes down to, so I mean, as Byron pointed out, the model for enterprise, so perhaps the top-down model rather than the bottom-up model, is perhaps more relevant in this case to the code-to-earn paradigm in the idea of de-risking some companies' licensing of software which contains thousands of libraries, which one of which might fail in terms of their license or was not licensed correctly, and then the whole thing, is unusable. So you're talking about like thousands of people pushing paper around in order to make all this work. You're talking about amazing waste and inefficiency on the human layer. So there's that. But even from the bottom up, I would say that the concept of authorship still persists, even though you might not necessarily feel the need to monetize it. And this is something which in academia we also have a keen sense of, which is that typically when we write scientific papers in academia, we don't care about making money off that paper directly. What we care about is our authorship persisting of that paper and our reputation in the community. So that can only be achieved really in the digital space with a form of digital identity that can persist, that is immutable, that is owned through a decentralized network, a blockchain, and that I think is something that could also be very attractive to coders.
Yeah, and I would just concur with this. I mean, I think it's definitely the adoption will come from the top down. I think open source coders tend to be very altruistic, and as soon as you mention monetization, they're going to run for the hills. You're not going to see them again. But if you have, for example, a situation where the enterprise companies are essentially trying to de-risk, and they're only willing to buy software that is on a blockchain somewhere that says, hey, I've bought this license, I'm okay with using this. So if there's a conflict, I can go to the judge and say, hey, look, we bought it, that transaction is there, it's on the blockchain, and they don't have this risk of having to shut down, lose millions in revenue. Then that's going to pull along these guys at the bottom. They're basically going to say, oh, okay, well, if I can make a bit of it and they're only going to buy from this marketplace, then I'm going to write my code and put it on there. I think that's the right approach to this, necessarily, monetizing code.
Guys, it's been a very long day at the Innovation Sidetrack. Thank you so much for your participation. And thank you to our panelists for their inputs and their insights. If you have any questions, please contact us afterwards. Thank you.